This is the talk of Music City Real Estate.
Welcome back to another episode of the Talk of Music City Real Estate, where we educate and motivate all things real estate. My name is Monte Mohr, and I'm also missing my cohort here, Carey Ann Cyr, but we've got Mr. Chris Corriveau of Midtown Untitled with us. Yeah, every week we try to bring lots of information for all of you guys, and today we're going to get into creative financing. I'm looking forward to this, Chris. Thanks for joining us, man.
Hey, well, Monty, thanks for having me on today, and I appreciate it. And I got big shoes to fill, filling in for Carey Ann.
Oh, man, don't even try. Don't even try.
I'm going to do my best, but I don't look great in heels, so I'm going to do what I can.
Thank you. Thank you for that.
Yes.
Anyhow, no offense to anybody.
No offense to anybody. Everybody wears heels, right?
That's right. That's right.
Seller financing. How about that?
Dude, I'm excited about this this podcast because, you know, it always humors me, or has in the past, where somebody said, "Well, we got creative, we got them, extra 3 days before they had to vacate," or something like that. Let me tell you real quickly how I got started in real estate. You know, when back in the day, okay, we were talking 4 decades ago, longer than most people have been on the planet, I know, but back in the day, there was this thing called an assumable non-qualifying loan, where you could file bankruptcy today and tomorrow assume that loan. Were you in business back then?
I've been in the business 3 decades.
Okay.
So I was on the back end of that.
Very tail end of it.
After everybody had already assumed their loans out of bankruptcy.
Okay, so you saw why they stopped that.
Yes.
You saw why they stopped that.
Yes.
Because there was too many of them that didn't make it much further than that. But anyway, so and imagine this, guys, to all our real estate friends out there. Imagine this. There's no MLS. The only MLS is a book, okay? And that book is just a black and white picture of each listing, about like that. Little tiny exterior shot. And in that little information there, you had whether or not that was an assumable non-qualifying loan or not. And so my first job as a realtor, I was instructed, well, because back then you called the seller directly to schedule the appointment. And I would have to call and you had to dial the phone. In fact, no, I think it was push button. I don't think it was
before the do not call registry.
Yeah, before that. Anyway, so you had to find a homeowner that, let's say, and my average sale price was $64,000 back then. Okay, this is early 1980s. You found an assumable loan. You made the phone call to the seller and said, "Hey, I've got somebody possibly interested in your home. If you will allow your first mortgage to be assumed, would you consider holding a second mortgage if my client will pay you full price for your house?" And they'd say, "Well, no, probably not." Or, "What does that look like?" Because I had to make a lot of dials to find that person, who would be willing to do that. Because let's imagine this: their price is $65,000, they owe $30,000. I'm going to ask them to hold a mortgage of $35,000, a full amount.
Right.
Okay. And then the real kicker was, would you be willing, in that mortgage, that second mortgage which they're holding, at typically a 30-year amortization with a 5-year balloon at 9 or 10% interest. I forget what the interest was back then, for those of you who are whining about 6 or 7%. And then they're going to sell the first 60 months of that payment to generate cash to bring to the closing table to pay me and their closing costs, and walk away with nothing. And
the buyer brings nothing.
And the buyer brings nothing, which was our investor.
Right.
And they walked away with nothing, except they knew on the 61st day, in a little over 5 years, they would get the balance of that mortgage that was amortized for 30 years. That's how I got started, man. So that's pretty creative.
That is as creative almost as it gets anymore.
Yeah, that's way more than what it gets, I think, anymore, because there's no more of those assumable non-qualifying loans. But anyhow, the point is, the reason I share that is,
we're starting to see more assumables right now.
Yeah, we are. But seller financing, creative financing in general, I think we're going to see more of that as well, as long as the rate stays up like it is.
Yeah, we are seeing more assumable loans, and I just want to talk on that for a second because we just came out of a time frame of unprecedented interest rates, right?
Right.
And so people are selling houses with these extremely low interest rates, and that your scenario is, how do people get paid the difference? And right now, what we're seeing in our industry is people are just bringing the cash to closing to settle up. I haven't seen a seller yet in an assumption situation finance that balance. So we're seeing people pay that difference up front between what they owe on the loan and what the seller is selling the house for. And so we want to talk about seller financing and why that's important, or even assumptions, or another word that's become really popular in our world, Monte, is subject to.
Subject to. I almost every week, one of our agents comes to me and says, what's this offer here that they're making it subject to them being able to take over financing, and my seller gets their closing costs covered, but isn't there some risk in that for that person? And I say, absolutely there is.
Yes, and so, that's the question I get. Subject to what? Okay.
Right.
So let's just kind of talk about a general seller financing house.
Yeah.
I got my house for sale, Monte, and I want to sell it, and maybe I don't need all the cash right now, okay? The market's a little volatile, and I either owe somebody or don't owe anybody on the house, but I want to sell it, and maybe I'm having trouble selling it, or I'm looking for more long-term mailbox money, and I don't need all the money up front. You can offer your house to do seller financing, which basically means I would act as the bank. If you wanted to come buy my house, you and I would negotiate terms, negotiate down payments. I would deed the property to you, and I would carry a mortgage back and a note back on the property, and I would essentially be the bank, and you would be the owner of the property, and you would make your monthly payments to me.
Very little closing costs on that, by the way, guys. Very little. But so for the seller's benefit I know obviously the benefit of the buyer is easy because there's minimal closing costs and probably not the scrutinization of qualification and so forth. But other than the income, I guess that's the main thing for the seller, is they're going to be taxed based on what they receive in payments, right? As far as capital gains taxes?
Yeah, so let's go through a couple buyers and seller pros on this. And, what are the benefits to the buyer? Why would a buyer want to do this? It allows the buyer who may not qualify for a traditional mortgage an opportunity at home ownership. Let's face it, if you can go get your own loan, you're probably going to go get your own loan, right?
Right.
But maybe there's a scenario that there's a reason you cannot qualify for a traditional mortgage right now. Maybe you're newly divorced, have some debt going on. Maybe you started a new business. And
you don't have enough time on the job yet.
Not enough time on the job yet. And lenders, they have guidelines and requirements that they have to do. And so that's number one, is that, it allows somebody to maybe have an opportunity of home ownership. The closing process is definitely quicker and cheaper. Don't have all the lender fees.
2 days or something like that, probably.
Yeah, pretty quick. Down payments are negotiable. Unlike traditional mortgages, there's no private mortgage insurance. There's literally little to no underwriting or credit analysis that goes on. And it can give the buyer time to get their credit repaired and be ready to get a traditional mortgage. And so, but there are some cons to buyers when they're buying properties like this.
Okay, I'm not familiar with the cons, I guess. What's that?
Yeah, well, because the seller assumes the risk of the financing of the purchase of the property, they typically charge a higher interest rate.
Right.
So that's number one, okay? Than standard rate. So what are rates, 6.5%, 7% right now?
Right.
Most sellers would charge a premium because they're absorbing that risk, and it may be 8, 9, 10, 11%.
Not only in interest rate, but possibly in price.
In price, I have agents or sellers ask me all the time, what do I charge? Or what do I do? And I always tell agents, first of all, they have to be, and sellers, they have to be really careful to not break any laws. They can't discriminate against individuals. They can't overcharge interest rates, because we do have rate caps in the state of Tennessee that are different than traditional credit card rates.
Right. But like a lease purchase, sometimes, in my experience anyhow, if you're offering cash, then you're going to get the lowest price probably. If you're asking for terms, you're probably going to pay a premium price probably.
Yes. I would advise any seller who is going to do that you're going to pay the premium. And really my advice, which is there's nothing out there that says this is right or wrong, is you've got to find out what the owner's risk tolerance is. And the more the buyer can put down, I'd probably be more flexible on my terms.
Right. The more security you have. Let me share a quick story. When I first got into real estate, I actually moved from Illinois down to Florida to get into real estate, and the first home I bought was an assumable mortgage with a second mortgage assumable as well, and I think I had brought like $3,000 of closing, assumed both mortgages. I made the agent mad when I made the offer, and I said, hey, you never know till you ask, and they came back and said, well, I would have bought it if I had known that they would do that. Well, then the house across the street, I got to know the neighbors. They lived on a canal. I said, man, I would love to own your house. He is an older guy. He owned it free and clear. And he said, I want $145,000. Imagine a waterfront for $145,000. That kind of dates how long ago that was. But the point is, he asked for $145,000. I said, Bob, here's what I'll do. I'll pay you $150,000 for this house if you'll play the bank, if you'll hold the mortgage for me, the 100% mortgage. And he thought, well, that's great. I know you. I've known you for 2 or 3 years, or whatever it was. And he felt comfortable with that. And I was more than happy to pay the premium. At that time, $5,000 was a big premium. And he played the bank. He held the whole mortgage.
Yeah. And it's just negotiating out. You never know what people are willing to accept or what they're willing to take.
No, what their needs are. I mean, some people don't need the cash. But anyway, go ahead.
Yeah. So, a couple other quick hits on this before we move on to the next topic on this is, these are usually shorter term loans, 3 to 5 years, and there's a call period amortized over that. As a seller, if you're looking to finance somebody, you can ask for anything that a typical bank would ask for. Credit reports, job information, bank account information. You just got to make sure you're in compliance with the law. You're not breaking the law. And you also, people get asked all the time, is it really worth it for a seller to do it? And what my take on that is, it just depends.
Depends on what their needs are.
If they need to buy another house right now, they're probably going to need that money up front, so it may not work for them. But if they're not, and they're looking for to get payment over time and get mailbox money over time, this may be a good option for a seller to entertain that.
I think so. I mean, I think that's where you could probably maybe lean a little harder on the downstroke to make sure that you feel secure, like a bank would feel secure. You're going to make sure that they're not going to walk away from that. So you want to probably get a little bit more down than maybe they could have gotten with FHA or something like that. But again, you're not going to have near the scrutinization as a buyer that you would getting new financing.
Yeah, and so a couple quick hits on this also is real estate agents, friends that are out there, or sellers that are out there. There's a lot of regulation and guidelines about who can be a lender and who can't, okay? Look at our friend Carey Ann, all the qualifications, all the training, all the licenses she has. So you're only allowed as a seller to do 5 of these over a 12-month period. So if you're somebody who is an adventurous person and wants to try to do this on a large scale, the state of Tennessee statutes do not allow you to do that, because if you do more than 5 over a 12-month period, you are considered a lending institution, and you are therefore subject to the rules and regulations that all financing institutions are subject to.
That makes sense. I'm curious, Chris, what if you were, let's say a scenario where you were thinking about doing that, and let's say one of your adult children said, hey, Dad, can I get this? Can you hold the note for me, or buy a house, pay cash, and then you play the bank for me? But will you only charge me, let's say, 2% interest, and the going rate is 6%? Is there any consequence in that scenario?
That's funny you ask that, because that happens all the time, right? The parents try to help their kids out if they have an opportunity, especially in the market we're just kind of coming out of, right? Where people were having to pay cash for houses. And yes, there's a thing the IRS terms imputed interest.
Imputed interest.
IMPUTED.
Wow.
And that's essentially what that means, is that the IRS can come in and charge the person who's lent the money a fee if they're not charging what a standard interest rate would be on a loan. So if the standard interest rate,
why would the I'm sorry, this is I guess a side note, but why would the IRS care what I charge somebody interest rate?
Yeah, so
because I'm going to make more money to pay taxes on? Is that
the interest you make is income, right?
I'm just kidding. I know that.
Yes, the interest you earn is income. And so you should be, if you are holding yourself out to be a lending institution or a lending individual, you should be paying market rates for those loans, and therefore collecting the proper amount of interest, and therefore paying the proper amount of income tax.
Wow.
And so, so if you're somebody who's thinking about doing that for your kid, you might want to rethink what your documentation say, and make sure you're working with a lawyer who understands how these.
That's an interesting twist. Thank you for bringing that to our attention, because a lot of people aren't aware of imputed interest.
Yeah, so we see it all the time, whether it's a family member, hey, I'd like to not charge any interest or 2% interest because it's family, but you just have to be aware when you go to file your taxes that there could be penalties and consequences for doing that.
So
they got their hands in everything, Monte.
Yeah. We'll stay out of that rabbit hole, but as much as I'd like to go down it. But so let's back up here just for a second. On a seller financing, you're the seller. You decide what your terms are. It's between you and just like a lease purchase, you decide whatever's agreeable to both parties, okay? If you're a seller, you want enough downstroke, obviously, that you feel secure. Typically, if somebody's paying you cash, you're going to get a little, maybe a little bit of discount or not. But if you're providing terms, that's a whole other story. Normally, you're going to get maybe a premium and or a higher interest rate than what you could get in the bank yourself with your money. Is that correct?
That's correct. And make sure if you are looking to do this, to get a qualified individual, an attorney on the front end. So you
do not write that on your own.
Do not go to Google. Don't try to get a friend to help you to do that, because if things do go south and you don't have the proper documentation in place, you could be in for a nightmare trying to get your property back, or maybe even be found accountable for something that you put in there that actually breaks the law.
Yeah, it's like buying a house without a home inspection. Don't do that.
Don't do that.
And don't put together terms and conditions yourself because you went online and found something. There's different laws in different states. Make sure that you invested in somebody like at Midtown to create that for you. I know that Jake has helped us with that more than once.
Yeah, we have 6 staff attorneys that we do this almost every single day, so we're very used to doing it. And the reason we wanted to talk about this and the subject twos and stuff today is because it's just very prevalent. We're seeing it day in and day out right now, and I know that you and your team of people are seeing the same things.
Yeah, so let's talk about that. You just mentioned the subject to word again. So let's talk about that, because I think of all of them, that's probably what I'm seeing the most, or at least the one that's causing the greatest amount of confusion, because I get this question a lot of times from our agents, even though we've talked about it a few times, like, what does this mean that they'll pay me the asking price? How does that not trigger a due on sale clause and all this kind of stuff? So let's talk about in lieu of, or not in lieu of, but in subject to.
Yeah, so this is going to sound like I'm downing the subject to deals.
I'm going to down it just for the record.
But I
don't think it's a good idea. Unless it's desperate, unless you're about to lose the house, you have nothing else to lose. Okay.
There are some good people I've worked with that have done this and have done the right thing.
Absolutely.
And I would say you just have to be very well aware and know and vet who you're going to be doing this kind of deal with.
Because you're connected with them for
as long
until that mortgage is paid off.
Yeah, so let's talk about a traditional assumption. We just talked about that earlier, right? Yeah. So that's where if I'm selling my house, you want to buy it, just like the scenario you discussed, you go to the bank, you qualified for the loan, the owner of the property is released from any liability from the loan, and the new buyer owns the house. They have taken over your loan. They have either paid you the difference that they owed you, or you have some other arrangement where the delta's been paid on that. And seller walks away, they have their money, and they're done.
If I fail as the new buyer to make the payment, it doesn't matter to that former person who originated that loan, because I have stepped in as the qualifying now new mortgagee, and they're out of the picture, right?
Walk away. Right. They get a release of liability from the lender. They're
done. I make the payment or not, it doesn't affect their future in any way.
Yeah. So that's an assumption. We see those a lot with VA loans, veterans, because they're constantly moving in and out. We see some in FHA. We've seen more now because the interest rates have been so low than we have in the past.
Okay.
But a new wave has come through with investors, and they're using the term subject to. And ultimately what that means is, I'm going to keep using ourselves because these are good examples. We're sitting here. I have my house. I have a 3% interest rate, but I'm in financial trouble, Monte. I can't get out from underneath the house. Maybe I'm a little upside down in it, or the numbers don't work, or I can pay commissions and get out of here. But I'm in trouble. I need to get out of here. What do? Well, Mr. Monte Mohr shows up. He is an investor extraordinaire, and he does this for a living all the time. And he says, I'll tell you what I'm going to do. I'm going to give you $15,000 in your pocket. I'm going to take over the payments of your loan, and I'm going to manage the property for you for the next 5, 10, even 20, maybe 30 years. Now, they use the term, I'm going to take over your payments, and it kind of sounds like they're assuming that, okay?
Right.
And don't you I think a lot of people think that that's automatically what they think is that they're going to come in, take over the payments, and then you get to walk
and have
away.
that mantle of responsibility on their shoulders versus yours.
Right. And in theory, what they're doing is they're coming in and they are just making the payments for you on your behalf to the lender. Okay?
So the responsibility hasn't shifted.
The seller of the property deeds their interest in the property to Mr. Monte Mohr, investor extraordinaire. Mr. Monte Mohr is an investor, and he's probably either going to long-term rent this house. Okay, that's most of what these investors do.
Right,
They
right.
want to rent. Why?
Right.
Because the cap numbers work better if you have a 3% loan.
Right.
You only have a few $1,000s out of pocket, you're down. And as you know, most investor loans require at least 20 to 25% down.
Correct. And they don't get as good a rate.
And they don't get as good a terms on those notes. And so if they find you who are me who's in trouble, they offer this opportunity for you. You get some money in your pocket. You walk away. I'm going to manage the property. But you are deeding your interest to the property to this investor person, and then they're going to make the payments for you, and they're probably going to rent the property out. And all the while, you're still responsible if this investor person does not make the payments on the loan. The loan is carried on your credit the whole time.
Wow.
And
so you went to go buy a car, and they pull that credit report. That house loan is still on your credit.
That's right. And you are not making money.
Right.
So you don't have any rent income that you're offsetting that. So you're essentially carrying that credit for this investor.
That downstroke was typically just to cover your costs and or maybe catch up with the delinquent mortgage. It was
a lot of them are behind.
Yeah,
you know, they need to get caught up to get squared away. And then this investor owns the house now. It's in their name, and they have a tenant in your house that you've never met, and that tenant is supposed to be paying rent to the investor, who then in turn is going to be using that rental payment to pay your mortgage payment as the
you hope
as the former homeowner of this property.
Now, some of them I think will give proof that they're making that payment, right?
Yes, and if you would have to understand to make sure that you're working with somebody who appears to be at least legitimate and knows what they're doing. We work with a few of these folks. There's some of them I would never work with because they just don't have the clients. And when I say client, the homeowner's interests best of you know, in mind. And so
I'll tell you real quick story again. When you've been in the business for 4 decades, there's a lot of stories. Okay, but relative to this, I had a client. I sold him the home here in Nashville. And they decided to, I think they moved out of the area for a while before they came back. Well, anyway, in that, somebody caught them on, I don't know where they caught them, Facebook, wherever. And they sold to them under these conditions. And and somehow the bank chased him down because he was arrear in payments, okay? Well, what are you talking about? The guy is supposed to be making this. Well, anyhow, the way this guy did it is he got my clients out of the house under this pretense, gave him a few bucks to get out, and he was going to take over the responsibility of the mortgage, and that's their understanding. He put tenants in there, because it takes sometimes, some lenders, it takes them months, sometimes longer, or used to be anyhow, to actually do the due diligence to find out what's going on in the property or whatever. But the point is, he wasn't. He got notified that the rent wasn't being paid. He knocked on the door of the house that he still owned, but in somebody else's name now. The tenant said, "I've been making the payments on time every month. What are you talking about?" And so he gets a hold of the guy who was supposed to have taken over his loan and his responsibility. And the guy had done this now to several people. He was living on that income, not making the payments on the property.
Yeah, and that happens, and you know
that's heartbreaking.
And so and it's a good point where you talk about the lender doing their due diligence. So let me tell you, the Fannie Mae, the standard deed of trust, all deeds of trust mortgages contain what they call a due on sale clause. And what that essentially means is if you are no longer the owner of your property and you have sold or transferred the interest of your property, the lender does not have a covenant with anybody but you. So that causes a default and an acceleration of the note, and the lender would call the note due. So I hope
everybody picked that up. Okay, that due on sale means if there's a change of ownership or any sort of something going on there, like a change of insurance person, okay, then that now that is due now, and if that was originated in in your name, guess whose problem that is, I guess.
Yeah, so there's a couple triggers that the lender would know, and that's the first one is your insurance. If look, as the owner of your house, you have homeowners insurance, right?
Right.
If you're no longer the owner of that house, guess what you don't have?
Is insurance.
You don't have homeowners insurance.
You can't get homeowners insurance.
Because you're not the owner.
Right.
So that means somebody else has to get insurance on the property, and they have to notify the lender who is a beneficiary underneath that policy.
Correct.
So the lender gets notified that the homeowners insurance has changed, which is in a new name.
Right.
They also get a property tax bill that's in somebody else's name because most people's property taxes are included in their payment.
That's true. That's true.
So that's number two.
So two trigger points.
2 trigger points right there that automatically put the lender on notification, which could trigger the lender to say you're in default. And most of these agreements I have seen between the subject to investor and the homeowner state that if the lender does trigger those, that investor bears no responsibility to cure that. So that basically falls back on the homeowner who has thought they have walked away, that they now have to fix this situation with their lender, or the lender's going to foreclose on them and ruin their credit.
Guys, this is why, both, I think, Chris and I both, overall, I mean, I know there's some good people doing this, okay? No fault to them whatsoever, but there's some other people that have made the waters muddy here by not making sure that homeowner is insulated, that real homeowner is insulated as much as possible, because at the end of the day, they don't have any responsibility. And in their documents, I've seen some of them say, hey, we have no responsibility here. We're going to do what we can, but if the lender does catch us, it's your problem, not mine.
Yeah, so what are a couple things homeowners can do if they're considering these situations? So one of the things I would do is ask for, you want referrals or recommendations.
Sure.
You want to be able to reach out to people that that maybe this investor has done business with. You want to talk to their clients, get referrals so you can actually speak to these people and make sure that they have been doing, how long have they been doing it? How many properties do you have that you have been doing this? Can you provide proof to me that the payments have been made current on there? The second thing you can do is you can make sure you have proper documentation that basically protects you as the homeowner, that if you find out that the person's not making the payments on the property or they're neglecting the property, that you have recourse to get the property back from them so you can take control of the house.
You've got to evict the tenant and all that. That's
you have to evict the tenant. It's not going to be fun, but at least you can get your property back. The other thing you can do, and these are some of the people I work with, is they actually have a proof of funds letter set aside that basically says that if the lender called the note due, they have sufficient cash to pay the loan off in full, and then they would go get their own money to cover the loan, but they want to be able to ride that interest rate as long as they possibly can, and maybe the lender would never find that out. But if the lender did, there's a mechanism in place to show that there is sufficient funds that would pay the lender off, and that seller would be made whole. So there are remedies out there to get around it, but you still have to put your faith and trust in what the people are telling you and what they're doing and what they're showing you. But most real estate agents, most buyers or sellers, they would have no idea what to even ask.
Yeah, Chris, tell me, I mean, there must be some ways that, I mean, this obviously works for some people, or they wouldn't be having the seminar showing how to make it happen, but how does a lender not going to find out about it once, because you mentioned two things, taxes and insurance. How is a lender not going to find out about it? Just some don't have policies to watch for that, or what?
Yeah, most of them are busy, backed up. They just, I mean, you could call your lender and they may not even know what subject to is, or they may not know what assumption is, because people they just haven't been around when this stuff was going on, when you and I were doing closings on stone tablets, they just weren't familiar with it. But the lenders will eventually find out at some point. Now, I do have some investors who do this, where we create, and they just pay the money and do it. They create a trust, a land trust. Okay. And the homeowners are part of the land trust, but they have no financial rights or governance rights underneath the land trust. But what that does is it allows them to at least plead their case to the lender that the land trust is just put in place for planning purposes, for either estate planning purposes or. So that's one way that the homeowner can actually stay involved. They wouldn't have any rights, but they could explain to their current lender that, hey, I'm still a part of this whole transaction. And so we've structured some that way with people. And when you're talking about people who are doing this, these are the folks that are out doing it right, okay? I'm not telling you that they do one a month, one a week, one a day. I mean, they may do one every 6 or 8 or 9 months because they just don't come around very often, and they're not people that are out there just trying to do like the guy you said, get as many as they can and never make the payments. But there are ways that you can try to protect yourself, but there always will be inherent risk if you do this type of transaction.
So that's subject to, guys. Hopefully you're taking some notes. We first did seller financing, and I guess subject to is a form of seller financing,
Sure.
I guess.
Sure.
So what other creative financing or seller financing options are there, Chris, that we can talk to people with? This is not, when rates are low, this is the last thing you hear about is anything creative. Basically, there's no incentive to do it. But now that rates are a little higher, people are still motivated to sell. They've got to come up with other answers.
Yeah, so there's a couple other things that I see out there. We don't see as many here in the city as we do out maybe in the rural areas, but installment deeds, that's what's an old school way of doing business. Okay. Yeah. And that's basically where it's like a rent to own. The seller would maintain ownership of the property. They would record a contract for the deed that says that you're going to pay me X number of dollars a month, and once that's paid in full, you'll get ownership of the property. So we still see some of those.
Lease purchase, lease option.
Lease option,
those kind of things.
and I was getting ready to hit on those. Those are two actually my favorites, okay?
Yeah.
Lease options or lease purchase agreements, and the only difference between a lease option and a lease purchase is in a lease option, the lessor has an option to purchase, whereas in a lease purchase, there is no option. They have to purchase.
Right.
But I love those for sellers because the seller maintains ownership of the property. The buyer's essentially a tenant in the property.
With the intention of owning.
With the intention of owning the property, and they're going to pay you. And if they don't pay you, you essentially just have to evict them.
You've got a non-refundable, pretty sizable deposit.
Yeah, and people a lot of times will structure it where part of the rent payment will go towards the down payment of the house.
Great point. And this sometimes becomes a fallacy, because what I did learn the hard way, because I put one of those together. I mean, I put many together over the years, but I found out that you can, just like your imputed interest, you can't give them credit back for anything other than what's over and above fair market rent.
Right, that's right.
Okay.
Same situation, right?
Yeah.
I mean, the IRS is involved. They want to make sure that they're getting their money. But for my money, if people are looking to do certain things, I understand the financial circumstances that may arise that would require you to entertain the idea of a subject to. But if you're looking at seller financing or looking for some mailbox money, my first go-to is always the lease to purchase or lease option.
Because you're still in control of the outcome.
You're in control of the asset still.
Yeah, and you have now you have a potential buyer who's got skin in the game,
right? Because
they got a non-refundable deposit. But here's something to always remember here: if you're helping put one of these together, first of all, the first question I get always is, well, how do I get paid as an agent? Well, that kind of depends on the terms that you and your client have worked out, and how much downstroke are you requiring for that buyer. The other thing is, understand this, in my experience and from what I've studied, there's only a small percentage of the people that actually get to the finish line in the lease purchase. Of course, that's partially dependent upon how long those terms are, how beneficial those terms are, how bad that person wants to own that house, that kind of stuff, obviously. But my point is, if you put one of these together, a lease purchase or a lease option, I don't care which, because at the end of the day, it's only as strong as that deposit, okay, that non-refundable deposit. If you put one of these together, try to get paid on the front end of it. Don't, even though that's not uncommon, to be okay about getting paid when they finally close on the property, because that's when the seller's funds are really loosened up. But the likelihood of you getting paid in that transaction later on is not great, so I try to get compensated on the front end.
Yeah, so for our agent friends out there, I get asked that all the time, as an agent, how do I get paid? And so real estate agents are paid according to the terms of their listing or buyer representation agreement. So the most common way that agents gets paid when seller financing is involved is from the buyer's down payment.
Right.
Okay.
Right.
And so
if there's enough.
There's enough. So that's why it's always advantageous to try to negotiate as much of a down payment as you can, because A, you want to make sure the sellers be able to bite, and B, you want to make sure as an agent that you're getting your compensation. But But this should be negotiated at the time of the contract. You want to talk about it. You want to figure out what the plan is in place ahead of time. And other options are the agent to be paid a percentage from the monthly installment. But that's risky, right? Because you have to factor that the buyer may default on the loan.
Yeah.
You have to make sure your brokerage will allow you to accept payments over time.
Right.
And then you're just trying to track those down. And one other option is, of course, with all the new rules and regulations are coming in, is the buyer could just pay you directly. But if they're doing seller financing and have a credit situation that's requiring that, there's probably a strong chance they don't have the funds to pay you up front.
I will say that very early in my career, I sold a home to somebody who was a new doctor, didn't have a lot of cash, but had good income. And I did exactly that. I put him in a situation where he was, seller financing. He didn't have any money. I don't think he had any money, if I recall right, but he's a doctor. And so I got paid $750 a month for, I think, 2 years for that commission. But I knew he was a good, solid person. And honestly, to make him a buyer, that was the only option that he had.
Yeah, and I haven't seen that in a long time. When we talked about the Great Recession in 2008, I had investors that were owner financing houses.
Okay.
And a lot of times the agents want to get paid. They would the investor said, hey, in order to make sure the buyer doesn't default, agent, you're not going to get all your money, and you need to make sure they make their payments because you're going to get paid.
Them in the loop.
Yeah, they want to keep them in the loop to keep everybody going. So that's happened. It's not a great way for the agents, but because it would have to drag them out and be a part of the transaction for an extended period of time. But get
at least half of it up front, guys, okay? Because, again, the likelihood of that getting to the finish line, if it's very far out, slim to none.
Slim to none. But anyway, so that's really it. Seller financing, lease options, lease purchase.
Great topic, man.
Installment deeds,
I'm telling you.
Subject to.
Yeah, thank you, Chris. I only knew, I think this last year, that you were so fluent in this topic, of creative financing. I like it because I got in, I'm not afraid of it. My very first sale was a rent-to-own situation. And so I've always had an open mind on this kind of creativity.
Yeah, and I got one more tidbit for our agent friends out there, okay? So if you are an agent and you have a client that's wanting to do owner financing, and if a seller of an investment property wants to offer seller financing, a good practice is to avoid indicating, offering, or presenting that seller financing is available in the MLS, instead of waiting for the buyer to make an offer. If that happens, your client risks violating holding yourself out to be a lender. So in short, the best practice is not to put that out there and offer that and let somebody make that offer to you. Now you're going, Chris, how is that possible? How's somebody going to even know that that's available to do it? You could say possibly seller would possibly entertain seller financing terms, but you definitely don't want to be putting seller will finance 90% at 7% interest rates.
Wow.
You don't want to put that out there because you as an agent could be holding yourself out to be a financial institution, and it could force your seller to be holding himself out as a financial institution. And think of how many agents are looking at the MLS on a daily basis, and buyers or sellers.
Wow.
And all it would take would be to somebody to turn you in to TREC or the Tennessee Department of Commerce and Insurance or the Mortgage Bankers Association, and you would be in a world of hurt.
That's something I didn't know, that if you're just marketing that you could be held responsible as holding yourself out as a lender.
Yeah, like I said when we first started,
incredible.
The state of Tennessee allows an investor to do 5 seller financial transactions over the course of a 12-month period to not be considered a lender.
Good information, Chris Corriveau of Midtown Title. How do people find Midtown?
Yeah, so we're all over the place, Monte. We're inside of Realty One Group here as well, servicing your great agents. But you can reach us at our phone number. Office number is 615-921-8684. You can also go to our website at www.midtowntitletn.com. Our main office is located in Nashville on Charlotte Avenue. We do residential transactions, commercial transactions. We deal structure. We help people with leases. We help people with contracts. We just are a full service title agency that can handle any type of transaction that you have.
And you speak seller financing, creative financing.
I do
awesome.
speak this. I have had to dust that hat off over the last few months, but I am actually very fluent in this, and I have to thank my mentors as I was growing in this business, because I got to learn a lot of it over some crazy times that you and I have been involved in.
Well, let me just say this, Chris, and we'll wrap this up, is that my belief is after 40 years in this business, seems like 40 decades sometimes, that one of the most critical parts of your team that you have surrounded yourself with, if not the most critical, I think lending is the most important probably. In Carey Ann Cyr, CMG, her team, they're amazing, okay, absolutely amazing. But the next most important is the closing attorney experience, because that is the last experience. And it doesn't matter how hard we work as realtors, it doesn't matter how a lot of other things go, if the closing experience is not positive, that's what your client, hopefully long term, remembers. And so it's critically important. Chris will attest to the fact that I used Midtown 5 times before I ever personally, not personal purchase, but personal sales, before I ever recommended them to our office and our team here at Realty One Group Music City, because I believe that strongly in first of all, referring those that I've had personal experience with, but second of all, that they're going to help hold up the bar in our reputation, because we only have one the last I checked, and only one reputation. So anyhow, Chris, thank you for doing all you do with Midtown Title and all the lives you serve and the lives you touch. And it's been a real pleasure having you on here today, man.
Thanks, Monte. And your team, the Realty One Group, they are an amazing partner for us. And I would have no hesitation recommending anybody to you guys, because like myself, we share a common bond of training, teaching, and educating our clients.
Thank you, sir. I appreciate you. Well, thank you again. We've been in another podcast with the Talk of Music City Real Estate. We're so grateful for your attendance. We do invite you to come back again next time. Thank you all.